Hey everyone, Ben here. Will government money printing and sky-high debt cause an economic collapse? And what can you guys do about it? Well, in this video, you're going to find out as I'm going to reveal my top 5 ways for you guys to protect yourself from any economic crisis, from all this crazy money printing going on. But before we get into that, if you're new around here, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. If you wish to take things one step further, hit that first link in the description below to be taken to the Patreon page where you can check out the VIP membership group. There you can gain access to my buy and sell signals and my entire investment portfolio. With that being said, let's dive in. Okay, let's level set really simply. What is a balance sheet? So a balance sheet is a financial statement which basically has assets on one side. This could be cash, this could be property, this could be things worth some sort of value. And on the other side, it has liabilities or debts. And you guys will know if you've watched this channel regularly, when I analyze a company, I'm looking for a company really, ideally, to have more assets than liabilities and debts, because then it's a much safer investment. And it's the same with countries. If a country has a poor balance sheet, that means it has a lot more debts than assets, then that can cause a crazy disaster. Now, of course, countries can keep printing money to pay off those debts, but at some point in time, kicking the can down the road will no longer work. And that is when we could see an economic collapse or even hyperinflation. So diving into this chart here, we can see the US has a share of the global debt of 31%. And in nominal terms, they have over 21 trillion of government debt. But really the key factor we have to look at with countries is their debt to GDP ratio or gross domestic product. So this is the economic output of the country. And what's the amount of debt proportional to that? So let's look at a bad example. We've got Greece. We all know what happened with Greece many years ago. They had a crazy economic crisis, and Greece's debt to GDP ratio is a whopping 275%, which is crazy. Japan, they went through a major asset bubble and tech bubble in the late 90s that popped, and since then their stock market, the Nikkei 225, has been moving sideways. Japan's debt to GDP ratio is 237%. Now, to put that into perspective, ideally, we want to be looking for a country with a debt to GDP ratio of at least less than 100%. And that means the country has enough cash or assets or economic output to cover those debts. Another example, Venezuela. So they have a debt to GDP ratio of 182%, and they actually had major hyperinflation. So people had to take wheelbarrows of cash to buy a loaf of bread in Venezuela. That's how bad it got. Now let's look at world debt by country. Now, according to this list here, the US is number 1. Now that is not a list you want to be number 1 of.
USA! USA! USA!
Second, we have Japan, China, Italy, France. Then the UK, they aren't doing good. Also, Germany, India, Brazil. So many countries have sky-high debts. Now, taking on debt, whether you're a business or a country or a person, is sometimes necessary and actually helpful to boost economies. For example, during World War II, many countries took on lots of debt in order to cover the cost of that war. And then, over time after the war, they paid off that debt. Gradually, this is what's supposed to happen. But many studies show that this debt since the 1970s has not been paid off and actually keeps compounding and compounding and compounding every single year because governments don't want to be unpopular. If you're in a government and you're in a position of power and you're an elected official and your job is to actually cut spending or reduce spending or raise taxes in order to reduce the country's debt, then that's going to be a very unpopular move. So what do countries do instead? Well, let's just print a load of money. And this is what's happening right now. Now, the founder of Bridgewater Associates, the world's largest hedge fund, Ray Dalio, he states that we could be coming to the end of the long-term debt cycle. And that could mean a financial disaster. There is actually a book which calls this a giant Ponzi scheme. To explain with a simple example, let's say we have somebody named Bob. He's earning $30,000 per year and he has $80,000 of debts. This is the state many countries are in right now. But instead of doing the fiscally responsible thing, which would be to reduce his spending and start putting that towards paying off his debts, and gradually over time, those debts will reduce, instead, Bob decides to take out more and more and more credit cards in order to pay off that debt.
You bought a car? without consulting me?
I don't recall being consulted when you bought that hat.
And he keeps going and keeps going and keeps going. So when one credit card is due, he gets another credit card and pays that. When another credit card is due, he gets another credit card and pays that. And on and on and on and on and on it goes. Now, we know just by common sense that that cannot go on forever. But this is exactly what countries are doing right now. And looking at this chart here for the US national debt as a share of GDP, we can see it's only been this high that it is right now back during World War II. And that was completely understandable. We're in a life-threatening war. We need to take on debt to build factories and defeat the enemy. But now, yes, we have got a global health crisis going on, but still, this debt was piling up even before this whole global issue. So what could happen? Well, firstly, we could have inflation. So what does inflation mean? So inflation is when the prices of goods and services tend to increase. Or in other words, the price of the dollar or the price of the euro or the price of the British pound, your currency, tends to decrease in value. Thus, things become more expensive. If you print money and there's more money in circulation, each dollar in your pocket is actually worth less than before the money printing started. Now, generally, many central banks, including the Federal Reserve, have a goal to keep inflation at around 2%. This actually benefits economic growth as the prices of things tend to rise over time. But what we can get is rampant inflation and even hyperinflation. And this is when price of goods can rise by over 50% per month and wages don't keep up with that price rise. This can effectively cause a bubble or even an economic disaster, and the whole currency has to be scrapped. Let me take you back in time and I'll show you a simple example. So the Weimar Republic in the 1920s, the German government, they had lots of reparations to pay after the war, and they had to do something about it. So what did they do? Well, the solution that all governments seem to be doing at the moment, and that is print money. So the Weimar Republic, they printed more and more marks, which was the German currency at the time, in order to solve the issue. Everyone was happy, people had lots of money, everything seemed fine. But then, as they kept printing more money, they realized the value of that money was actually a lot less, and thus there was a national disaster called hyperinflation. People actually had to have wheelbarrows of cash in order to buy a loaf of bread. People were stacking up cash like a house of cards just for fun. People were getting cash, making kites out of it, and using it as toys. This is crazy. This is how worthless the cash was in Germany. So what was the solution? Well, they had to scrap the mark, which was the German currency, and they had to bring in a new currency called the Rentenmark. Now, you may think, okay, we've learned from that. That was many years ago, but the same things happened many, many times. It happened in Zimbabwe in the 2000s, even happened in Venezuela in 2010. This is why Ray Dalio, the world's largest hedge fund manager, says cash is trash, because he knows cash is not a good investment. It actually devalues without hyperinflation. Cash devalues at 2% per year, if you're lucky. If we have inflation or increased inflation, it could devalue at 10%, 20%, 15% per year. So that's something you guys need to be careful of. There's also commodity inflation or food prices inflation. So you may have noticed the price of food has been increasing over time. Now, food prices have risen on average at 2.6% per year. This is due to many reasons. One is climate change. Another is the fact that people are actually eating more meat. So many countries, especially those in Asia, have now started to eat a lot of meat, the same as many people do in the West.
Another burger, Dad?
Here you go!
It's bad enough they're all eating meat. They don't have to rub it in my face.
Thus, more grain is required to feed the animals needed for meat-based meals, and higher demand for meat means higher grain prices over time, and that price increase will be passed on to the customer, and everyday working families will feel that in their pockets when they purchase their shopping. Now, I'm not trying to put the fear into you guys, and you guys will know if you watch this channel regularly, I try to offer solutions always, because I think moaning about problems, talking about economic problems, we'll save that for the guys on CNBC. They can keep talking about it, we'll keep acting and implementing solutions each and every day. So in this video, I'm going to give you guys my 5 solutions to protect yourself from any hyperinflation or economic disaster which could come from this sky-high government debt and all this crazy money printing going on. But if you guys have found some value in this video so far, feel free to give the video a big thumbs up. That helps out tremendously with the YouTube AI. Kicking things off at solution number 5 is diversification. Now, I know what you guys are going to say, Ben, diversification, you always say this, but it's so true. Diversification is the only free lunch you get in investing. You should be diversified across businesses, across industries, across asset classes, across capitalizations, globally, in order to protect yourself from any economic uncertainty. Second, invest in gold. Now, I'm not saying you should have a large portion of your investments into gold. I don't personally believe that. I personally follow the 5% rule, which is 5% of your portfolio in gold. That basically acts as a hedge against this currency uncertainty. Because although they can keep printing more money, there's only so much gold on this planet, and that actually has to be dug out of the ground. Some value has to be input in order to bring that out, and it has to be put through a foundry. All that work that has to be done does give the gold some sort of value. For example, if we took all the world's gold, we actually end up with 171,300 tons. But still, that's only a cube 20 meters on each side. And this would actually fit in the Wimbledon Centre Court, as you can see from this image right here. Now, you guys are going to ask, how can you invest in gold if that's what you wish to do? I suggest using the iShares Physical Gold ETC. ETC stands for Exchange Traded Commodity. Now, this basically just allows you to buy it the same as you would normal stocks. But the great thing about this is you can rebalance fast, very liquid, which means you can buy and sell very easily, and it's very easy to do, and it's protected. Many of you guys may say you need to own physical gold, and you can go out and buy gold bars and coins, which some people do. Personally, I find that quite impractical, and also that comes with its own risks. So first, you have the risk of robbery. If you've got a lot of gold in your house and people know about that, that could make you a target. Also, there's practicalities. Let's say there was some sort of economic disaster and you need to liquidate that gold quickly into something you can use in order to spend or to buy things or to pay your bills. You'd have to go to a jeweler's. You'd have to try and get them to buy the gold off you. But let's say there is this economic disaster. They might not want the gold or offer you a good price at that point in time. So there's a lot of impracticalities with it. So unless you're uber wealthy, I don't think you really need a massive compound of gold bars. Now, we'll also talk about Warren Buffett, because Warren Buffett historically hated gold. Buffett famously stated gold is dug out of the ground in some place like Africa, transported over to the US, and then buried again under some bank in the US. I'm paraphrasing here, but the point still stands. Berkshire Hathaway, though, this year actually invested into a gold mining stock, and this shocked many people. But then later in the year, they actually sold out of this position. Now, it's all very interesting stuff, but it's clear that Berkshire Hathaway liked the fact that gold mining stocks, many can also pay a dividend. So it's not the same as normal gold, which doesn't produce anything. Now, I've got a full playlist on gold mining stocks, so I'll leave those in the description below. Then there's also silver. So silver is like gold on steroids. When gold moves, silver tends to move also. But the great thing I do like about silver is often overlooked. And silver actually has many industrial applications. For example, diving into this chart here, we can see silver, over 54% of silver is used for industrial applications, over 15% for photography, 26% for jewelry, and then 5% other. So that is the hedge that people are using. But that's great because that means you're not just getting the benefit of something that people are keeping in their drawer in order to protect themselves. You're actually getting the benefit of industry using this material. Plenty of videos on silver mining stocks, so I'll leave those in the description below. Also, now the fourth one, this is really interesting and you guys are going to think I've gone crazy, but it's to invest into Sweden. Now this may sound random, but Sweden is not just known for beautiful landscapes, people, and the pop group ABBA. Sweden also is a country which has very low debt to GDP ratio compared to the rest of the world. They're actually responsible when it comes to debts and liabilities. Diving into this chart here, we can see Sweden is right down at number 31 with a debt to GDP ratio of just 38%, with gross debt of just $214 billion. Now, as mentioned previously, comparing that to the US, which has a debt to GDP ratio of over 104% and gross debt of over 21 trillion, then you can see there's a major difference there. Not just on the gross amount, but on the percentage to GDP.
USA! USA! USA!
Now, I've actually done another video on my top 3 Swedish stocks, so I'll leave that in the description below for you guys to check out. And on to number 5, and that is to invest in commodities. So commodities, these are things that we all need and use. This could be wheat, corn, oil, gold, or even rare minerals such as lithium and nickel. If the major boom which is predicted for electric vehicles is to actually happen, then all those electric vehicles, all those EV batteries will require rare minerals such as lithium and nickel. Again, I have many videos on lithium and nickel mining stocks, and I actually did a video many months ago before anybody was talking about this, and I actually predicted the lithium mining company which Tesla would purchase. And many of you guys, many of the community made an absolute killing on that investment. So, congratulations. Alright, that's today's video. As a little bonus, of course, investing into normal stocks, also investing into great companies, holding them over time is also going to protect you against many of these major issues. So if you guys found some value in this video, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. If you're new around here and you still haven't joined the investing family, what are you waiting for? Go ahead, hit that subscribe button and turn that notification bell on. If you wish to take things one step further, hit that first link in the description below to be taken to the Patreon page where you can check out the VIP membership group. There you can gain access to my buy and sell signals, so when I make my moves, you can make your moves. In addition, you can access my entire investment portfolio, the stocks and the story of how I grew that portfolio from just $20,000 to over $200,000. So if that's something you guys are interested in and you want to be part of an investing family which is moving towards a successful point in their lives, and you can also ask me direct questions on there about your own personal portfolio, then you should definitely click that first link in the description below to just check it out and find out more. And don't worry, it's not some expensive course, it's only the price of a coffee. And I personally think the amount of value you can get, and many members of the group also know the amount of value you get, is absolutely incredible. Don't believe me? Feel free to check it out on the link below. With that being said, I hope you guys have a tremendous day. I've got so much love for you guys. You've continued to support this channel for so long now. And I'll see you guys in my next video. Invest safe.